Joining us now to discuss President Trump's latest trade agreements is Javier Palomarez, founder, CEO, U.S. Hispanic Business Council, and former Obama campaign advisor, and Hadley Manning, executive vice president and fellow, the Steamboat Institute. So good afternoon to you both. Javier, I'll start with you today. On the new U.S. EU trade deal, President Trump called this the biggest deal ever. How would you characterize Trump's overall approach and process to securing this deal?
Well, thank you, Don. I think the net effect is that there will be increases in tariffs on imports from the European Union from 1.5% to 15%. Concurrently, it will reduce tariffs on exports to the European Union down to 0%. It also includes, in broad strokes, it includes a pledge from the European Union to buy some $750 billion of American energy, which is, I think, a fantastic step. I think that's a great aspect of this particular deal. That's almost a 900% increase from where we are today. And it also will include investment from the European Union of some $600 billion into America within the next 3 years. That's going to have a very positive impact on our economy. And it will include, by the way, investments in manufacturing, which longer term will be very good for the American economy and the American people.
Okay, Hadley, can we get your thoughts on what you think about the deal?
This deal is representative of the Trump doctrine on international trade. President Trump goes in with a very large opening bid. Earlier this year, we heard threats of even 50% tariffs on the EU. And now at 15%, yes, that will be higher than what the tariff rate on European goods has been, but it will not be the 30 or 50% threats that President Trump initially started with. So you can say that this is a big win for the United States because of precisely the investments that Javier mentioned in energy and in other American goods. It fits within the Trump doctrine to raise these tariffs because ultimately the Trump administration has their eye on trade deficits. They have their eye on the balance of exports and imports that the United States shares with our European trade partners. And ultimately, the European Union only had so much choice here because obviously access to the American marketplace is of utmost importance to our partners in the EU.
So Javier, building on what you said earlier and what Hadley is saying, would you like to go further in depth into specifically the short-term and long-term economic impacts that you expect?
Yeah, and again, I'll begin by saying I completely agree with Hadley. This is a part of a broader strategy that is multifaceted. If you look at it, try to put it into context, automobiles, furniture, pharmaceuticals, luxury items, some machinery, the cost for that is clearly going to increase. To put it into some context, look at it this way. Your Mercedes-Benz, your BMW, your Volvo may increase in price. So may your Rolex, your Gucci bag, your Louboutin shoes. But frankly, the Americans who have the wherewithal to purchase those types of items can probably absorb a 15% hit. And customer and consumer behavior will likely not change that much because those products are attractive to a particular segment of the American population with the financial resources to purchase that. These are the types, I think, of things that we can do to put this thing into context. It's hard to tell ultimately where we will end up here. But Americans purchasing those types of items surely will see a difference. At the end of the day, the European Union accounts for about 20% of all U.S. imports. And that's a big number. But to go a little bit further, the European Union is comprised of 27 nations. Together, those 27 nations account for 20% of all imports. But look at it this way. Our number one trade partner, Mexico, by itself, accounts for 15% of imports. Our number two trade partner, Canada, is about 11% of imports. And our number three trade partner, China, is about 16% of imports. So those three nations alone account for nearly 50% of all imports, while the other 27 nations, again, like France, Germany, Italy, Sweden, Spain, Greece, the Netherlands, etc., they only account for 20%. So it is an impactful deal. It will surely have some short-term impact in terms of prices rising for a little bit, between maybe 2 to 5% short-term. But the long effect is that this is a net positive for the American economy. I think in the long term, we will be much better off with this deal as it exists today. And as Hadley said, the good news here, it could have been 30%, it could have been 50%. We're at 15%. And so I think from this point on, it's the implementation, getting used to it, and moving on to the next deal.
Right. Okay, so Hadley, you mentioned the trade deficit earlier. I want to get your thoughts on that, and as well the same question I proposed to Javier. So Hadley, I'm optimistic that the trade deficit will be reduced as a result of this deal, but I'm not an expert on this subject. So by your analysis, will this deal make a meaningful dent in the trade deficit between the U.S. and Europe, which last year surpassed $235 billion?
You know, there are different schools of thought here when it comes to trade deficits, and some economists will tell you that trade deficits between two different countries, or in this case, two major entities, we can consider the EU almost like one major trading partner because they come to the table as one when they make this deal with the United States, that those trade deficits should not be where our attention lies, that ultimately, because we live in a globalized economy and there are multilateral trades taking place between a variety of countries around the world, some economists will say that's an interesting statistic, but it sort of ignores the benefits of trade. It ignores what lies behind those numbers. On the other hand, I think this fits with the Trump doctrine. The Trump administration believes that we should be paying attention to those numbers, that ultimately boosting net exports from the United States globally, including two specific partners like the EU, is an important goal. And that's why they are pursuing these types of deals. I think this deal announced on Sunday is intended to, precede a potential deal with China and signal to other international trade partners that have not yet reached a deal with the United States that those deals are possible and should be made, and that ultimately they'll benefit the global economy by having more security and stability to move forward. And I want to add on to your first question to Javier, your previous question about impact on American businesses and consumers. Announcing a deal like this on a Sunday means we're all anxious to see what happens in markets on Monday, now into Tuesday of this week. However, in this particular case, Americans and our financial markets are looking to two major pieces of uncertainty that haven't quite been resolved. One is that trade deal with China that we're hoping to see in the next couple of weeks, or some kind of extension on the truce there. And then another big piece is that the Federal Reserve will decide on interest rates on Wednesday of this week. And so I don't know that we're fully seeing the impact of the EU trade deal in our financial markets. And we're certainly not seeing the impact on the price of consumer goods, because that will take time to work itself out. American producers will have to look at, how many of their inputs come from the EU and how that affects the downstream price to American consumers. And of course, we're looking at a very broad set of trade deals. As Javier mentioned, we have many trade partners. This is just one piece of the puzzle.
So Javier, when we're talking about the Federal Reserve, consumers and prices, what are your thoughts on inflation? Do you think this will push it higher, or do you think it will be negligible?
I think it'll be negligible. I think we'll see some price increases on products coming from the EU. Again, maybe 2 to 5% during the short term. But look, I kind of look at this thing, as simplistically as I possibly can to kind of wrap my head around it. And you look at the puts and the takes. The takes, obviously, some price increases. The upside, though, it creates certainty. It creates a clear set of parameters, and that is absolutely important, of tantamount importance to the American business community. We need to know the path forward. We need to know the parameters so that we can begin to invest, to plan, and to grow our enterprises. This creates, at least for this set of trading partners, a clear path forward, and it sets the parameters. Again, it could have been a lot worse. So I look at that. I look at it from that perspective as well. And then finally, it creates a win. And it may be psychological, but it's important because that win puts us on good footing because the three big boys are yet to come. We've got Mexico, we've got Canada, and we've got China on the horizon. We've got to deal with those three trading partners, and certainly China among those. That's the big one. This is a good win for us. It puts us on good footing, and it gets us ready to deal with China because that's a specter that comes next.
So Hadley, correct me if I'm wrong, but these tariffs, somebody has to pay for them, right? And is it American companies, American exporters, or rather importers that have to pay this? And if they do, does it stand to reason that we're going to see price increases to a certain degree?
That certainly is theoretically true, and the consensus among economists is that U.S. consumers ultimately pay the price of these tariffs. On the other side of that balance sheet, tariffs are projected to raise revenues for the federal government. Tariffs are ultimately a tax, and so that could be a good thing that we increase our revenues from, external sources. But those external sources ultimately may turn out to be internal, as the goods that come into the United States that American consumers want to enjoy will have increased prices in order to ultimately fund these tariffs. So that is certainly the theory, and that is what most economists believe, that ultimately U.S. consumers pay the price. Unless, however, and I think this is the long-term goal of the Trump administration, we see seismic shifts in the choices that American consumers are making away from foreign goods towards more domestically produced goods. Even in that case, many domestically produced goods have inputs that come from the rest of the world. We have a very globalized economy, and working back from that place, reshaping the American economy back to one that focuses more on manufacturing and homemade goods is quite the tall order, but it's one that the Trump administration is trying to take on.
And Javier, you talk to a lot of businesses. What are they saying? Are they happy about this deal? Are there any concerns? Are those concerns being addressed? What are you hearing from businesses?
Our membership includes 4.5 million businesses. And we also work with and partner with all the largest corporations in the nation. So as you can imagine, what we're getting is very varied. It depends on, whether that particular conversation is with somebody that exports or net somebody that imports. Importers are going to feel it because, we're at 15% now. And it seems like it was overnight, and it was. Clearly, they're going to have to find solutions. Clearly, one of those solutions will likely be price increases, and ultimately the American consumer will pay. But again, when you look at exactly what it is that we are importing from those nations, I think it's manageable. I also think that the investment, the hundreds of millions, billions of dollars that the EU will invest in the American economy and into manufacturing, I think that can help mitigate the pain that we're going to feel. I believe that ultimately the goal is to begin to, manufacture some of these goods here in the United States so that we don't have to talk about tariffs, but rather we're creating our own products right here in the nation that we love so much, just the way it used to be. And so I agree with the path that we're taking here. It is a tough road. These are tough choices, but I think that it is time for a different administration to try a different approach. I am hopeful that this deal ultimately will be a great deal for the United States. I'm enthused by what I've seen thus far. Ultimately, the consumer will react, the market will react. But even then, the Dow reacted very positively and almost reached record highs yesterday. So early indications are that we can weather this very, very easily. And again, I believe that net, this is a good deal for the American economy.
Okay, Hadley, I'll just end with this question to you. Looking at Trump's recent trade deals, whether it's with the EU, of course, Japan as well, the Philippines and others, what is Trump's global economic strategy, and is it becoming a reality?
I believe his global economic strategy is the same as his national defense strategy, which is America first. He wants America to maintain and even increase its dominance in the world economy. And in terms of trade, that means making strong decisions, making strong deals with other countries, forcing them to the table, forcing them to accept sometimes his terms, or at least something that he may back off of his opening bid, but he ends up with a higher tariff rate or a greater rate of investment in the United States. So he is playing to win. He's the author of The Art of the Deal, and he's bringing that philosophy to our international trade deals. So he wants America to be dominant. He wants other countries to recognize our dominance and come to the table for that reason. And I think this EU deal is representative of that. I think it fits in with the broader strategy, and I think it's what we'll continue to see more of.
Well, okay, Hadley, Javier, thank you both for coming on today. It's been a pleasure.
Thank you.
Thank you.